and welcome back to the show. I'm your host, Lance Roberts. Talking a little bit about, investing and, kind of understanding how things work. I was at dinner with my wife, and sitting next to us was a financial advisor who's probably in his mid-30s, talking with a client of his that was in his probably mid-60s, and having a conversation about the recent market volatility that we've seen. And of course, we had this sell-off in December that was, pretty steep, wound out to the December 24th lows. We're down about 20% from the highs. And during the conversation, he says, don't worry about anything because the markets grow on average about 8% a year. And, this is certainly understanding, because when we look at things, this is how it's commonly told. It's like over 100 years or so, markets always grow at 8% a year, so nothing to worry about. The problem is, and when we're having this, and when you think about this, is not just a function of how markets grow over time, but how much time do we have to get there. And so I wrote an article. It's called "The Third Strike is going to be the last of the bear markets for a lot of baby boomers," because when you start thinking about time as a function of our investing horizon, it becomes a much different story. So the chart that he was referring to was simply this one, which is when you take a look at the S&P Total Return Index going back for 118 years, it certainly shows that drawdowns in the market are far less, at least it seems to be on a percentage basis, than with what the bull markets are. So, bull markets in, heading up in 1999, the market was up 665%. The drawdown was only 42%. So obviously, if you're up 600% and you only lose 42%, well, that's not such a bad thing, right? Sounds pretty good. Currently we're up about 220% since the lows in December of 2009. So, how bad if you lose 50% of your money on the next drawdown? That's certainly not that bad of a thing. Well, see, percentages, though, as Mark Twain once said, lies, damn lies, and statistics. Percentages are very deceiving in terms of what happens actually with money. If we recalibrate this chart to actually look at it in terms of point gain or point loss, see, it becomes a totally different thing. That run up in up to 1999, the market went up by 1,895 points. During the decline in 2001 and 2, the market lost 1,020. So basically a huge chunk of the returns that were garnered during the 90s were lost between 2001 and 2. The rally that lasted from 2003 to 2007 was up 709 points. We lost 966 points during the 2008 financial crisis. In other words, you wiped out the entirety of the bull market from 2003 to 2007. Currently, we're up 1,971 points from the lows to the peak of the market. The question is, if we have another big decline in the markets, how much of the current rally that we've seen over the last decade will be basically wiped out? And this is what happens to investors over time and repeatedly occurs. And in fact, if we look back at the markets over the last 118 years, there's only been 4 periods in the markets where the markets actually made money. The rest of the time, the market spent getting back to evens. And we're talking about long periods of time, 23 years to get back to even after the peak of the market in 1965. It took almost 14 years to get back to even after the peak in 1999. So when we start looking at these very long-term time frames of just getting back to even, this is why a lot of investors and a lot of people don't make money in the markets over long periods of time. It's often talked about just buy and hold, ride the markets out. But just remember that getting back to even isn't necessarily the same thing as making money. And a lot of this has to do with where we are. Currently valuations on the markets are 30 times earnings. It's certainly very elevated, and it corresponds with previous peaks in the markets going back over the last 100 years, where returns over the next 10 or 20 years tend to be substantially lower than they were previously. So we've just gone off of, and think about this, if you think about the markets like a rubber band, we get into a period of time where returns are very elevated because we're coming off a very depressed level. So 2008, not surprising, great financial crisis. We imputed a lot of liquidity into the markets through the Federal Reserve, through the government spending, government programs like cash for clunkers, cash for housing, you name it. But also valuations were depressed and sentiment investor sentiment was extremely depressed. That is a prime setup for a very, very big run in the markets, which we've seen really since the financial crisis. So we've had a decade of gains. But thinking about it like a rubber band, the markets expand in one direction, they're ultimately going to contract in the other direction as well. And so as we start getting into the next cycle, which will ultimately be a correction because everything has a full cycle, right? We have a bull market that's always followed by a bear market. And that's not a bad thing, it's just the way the markets work, so don't worry about it. But when we go through this correctionary cycle, forward returns are going to fall. And so we've talked about here recently that expectations for investors over the course of the next 10, 15, and 20 years need to be greatly reduced. Expectations of 8 or 9% returns in your portfolio, you're going to be very disappointed because simply the markets aren't set up currently to deliver that kind of return over the next 10 years. And so the one factor that's never brought into this conversation, and again, I was listening to this conversation between this young person, I say young, mid-30s. That's a kid for me these days. He's in his mid-30s. He's probably never actually been through a bear market. And this is one of the interesting things about where we are currently. We're a decade into a cyclical bull market. And a lot of advisors, think about this, a decade ago, an advisor that's in his 30s was in his early 20s, probably really wasn't in the market at that time during that 50% drawdown in the markets. There's 13 million-ish financial people in the finance industry that have entered the finance industry post-2010. So there's a lot of people in the markets today that have never actually seen what happens during a major bear market decline like we saw during the financial crisis. So experience is a very valuable teacher here versus historical theory. But importantly, the one thing that's never imputed into these conversations, and particularly for this gentleman, he's in his 60s, is talking about life expectancy. For most individuals, we don't start really saving and investing money until we're probably 35 to 40 years old. Why is that? Well, we're trying to get our life together for the first thing, right? We're trying to get a job. Then we've got kids. We've got to, buy a house. We've got to raise our family. And that takes basically all the money we've got coming in to do that. So we don't save a lot of money. In our 35, 40, 45 years of age, we start getting a bit more serious about saving and investing money. Well, we're not going to live forever, and our retirement is going to come upon us to where we're unable to work at some point, say 70 or 75 years old. We're going to stop working. We're going to have money to live on, etc. So our time frame for savings and accumulating is not 118 years. It's probably about 35 years. But even if we just say, look, we're going to work and save until the day we die, right? We don't start that process until 35 or 40 years old. So if we take a look at the cycle of, say, an individual starting at 35 years of age and working and saving until they die, and imputing life expectancy, there is not one period in the market over the last 118 years when you're starting at valuations of 30 times earnings that investors made 6% a year on average. And it's just simply a function of valuation and time. They died before they actually got to the point to where the markets had reset to generate higher rates of return over time. And this is one of the key issues here, that when we start looking at this, is that it's important to understand the impact of time as it relates to actually investing for money. Because as we start to invest money and actually paying attention to what's going on, the function is that the time factor we don't get back. When we spend a period of time, say 10 or 11 years, just getting back to even, that is 10 or 11 years of our growth and investing time that we simply waste allowing it to just try to get back to even. Because again, remember, just like a pension fund, these pension funds require 7% returns every year in order to meet their goals, right? So they can support their pensionees. Same thing for investors, is that we have to have a period of time, 30, 35 years, to grow our money, to make sure we have enough money to save in retirement to live on. If we spend 10 years of that getting back to even, or if we spend a couple of periods just getting back to even, that reduces the amount of time that we have to reach those financial goals. And this is why, one of the kind of the things that Wall Street does to investors that's really a disservice is trying to encourage individuals to beat a market. And this is, we hear about this all the time. It's like, oh, market's up, 5% this year. How did you do? If you didn't beat the markets, you need to change what you're doing. Don't worry about what the market's doing. The S&P is an ethereal issue. It has no cash. It has no real investments. It's just an index. It doesn't have a time frame to invest with. And trying to beat some index like that requires you to take on substantially more risk than you would otherwise, because we begin chasing returns. And yes, while it's great to make money, we're all excited when markets are going up and we're making money. That's a great thing. But if we wind up losing a large chunk of that capital simply because we're taking on too much risk, and we go through a period of time where we are just getting back to even, not only did we destroy the value of compounding of our money, but we've also destroyed the one commodity we can't replace. Yes, we can always get our money back, right? We can always grow our money back and get back to where we were, but we don't get back that time that we lost getting there. And again, we only have a finite amount of time to get to that goal ultimately of reaching our financial objectives. So what's more important in investing over the long term, and why we're so dedicated to capital preservation and conservation of principle, is to protect the value of that time that we have, because simply those are years that we don't get back. It doesn't mean you're going to make money every year in the market. Nobody's ever going to say that. But the point is to make sure you understand the difference between growing money and getting back to even. Be right back after the break. I've got some other stories to get into this morning. You're listening to the Lance Roberts Show podcast right here at realinvestmentadvice.com.
This one for them hood girls, them good girls, straight masterpieces, styling, wildin', living it up in the city. I got tracks on, we safe for arm, gotta kiss myself, I'm so pretty. I'm too hot, damn. Got a ball leaks and a fireman, I'm too hot, damn. Make a dragon wanna retire, man, I'm too hot, damn. Say my name, you know who I am, I'm too hot, damn. Never bad about that money.
Catch Lance Roberts' podcast later at lancerobertsshow.com.